In today's world, uncertainty is a constant. Whether it's economic slowdowns, market fluctuations, or global crises, the fear of a recession looms large over investors. But here's the good news: building a recession-proof investment portfolio is not only possible, it's smart. A well-thought-out portfolio can help protect your wealth during tough economic times and position you to come out stronger when the market recovers. In this guide, we'll walk you through the essential steps to building a recession-proof investment portfolio. From asset diversification to selecting the right types of investments, we'll cover everything you need to know. So, whether you're a seasoned investor or just starting out, this guide will provide actionable insights to help you safeguard your financial future. Let's dive in. Chapter 1. Understanding recessions and market downturns. Before we jump into how to build a recession-proof portfolio, it's essential to understand what a recession is and how it impacts the market. A recession is typically defined as 2 consecutive quarters of negative economic growth, marked by a decline in gross domestic product (GDP), rising unemployment rates, and decreased consumer spending. During a recession, businesses often see reduced profits, stocks may fall, and uncertainty grows. This is where investors start feeling the heat. Why do recessions matter for your portfolio? During recessions, markets tend to experience significant volatility. For example, stock prices might plunge, some companies might go out of business, and others might struggle to maintain profitability. As an investor, if you're not properly diversified or don't have the right asset allocation, your portfolio can take a serious hit. The good news is that with the right strategies in place, you can minimize the negative impact of recessions and protect your investments from severe losses. Chapter 2. Asset diversification. The foundation of a recession-proof portfolio. One of the most critical strategies for building a recession-proof portfolio is diversification. Think of diversification as spreading your investments across different asset classes to reduce the risk of any single investment negatively affecting your entire portfolio. The idea is simple: don't put all your eggs in one basket. Let's break down how diversification works and why it's essential. Equities, stock. While stocks can be volatile, they are also an essential part of any long-term portfolio. However, during recessions, growth stocks tend to underperform, so it's important to focus on more defensive stocks, companies that are less sensitive to economic cycles. Think of sectors like consumer staples, food, beverages, household goods, utilities, and healthcare. These industries provide products and services people need regardless of the economic climate, which makes them more resilient in downturns. Bonds. Bonds are traditionally seen as safer investments compared to stocks. They offer fixed interest payments over time and are less volatile. When the economy slows down, the demand for safer assets like government bonds tends to rise, pushing bond prices up. Incorporating high-quality bonds, such as U.S. Treasury bonds or municipal bonds, into your portfolio can help smooth out volatility during a recession. Real estate. Real estate can provide a hedge against inflation, and rental properties can generate steady income even during economic downturns. While the real estate market can be cyclical, residential properties in areas with strong demand can hold their value better than others. Real estate investment trusts, REITs, are another way to gain exposure to the property market without directly buying property. REITs tend to perform better during times of economic recovery, and some provide regular dividend payouts. Commodities and precious metals. Commodities like gold and silver are often viewed as safe havens during times of market uncertainty. Historically, gold has been a strong performer during recessions and periods of inflation. By holding commodities or investing in precious metals ETFs, you add an extra layer of protection to your portfolio. Cash and cash equivalents. While cash doesn't generate returns, having a portion of your portfolio in cash or cash equivalents like money market funds or short-term bonds can provide safety during turbulent times. Cash allows you to take advantage of opportunities when the market hits rock bottom or when stocks are undervalued. By diversifying across multiple asset classes, you reduce your reliance on any one investment, giving your portfolio more stability. During a recession, while some assets might decline in value, others may increase, helping you weather the storm. Chapter 3. Allocating your portfolio for recession resistance. Now that you understand the importance of diversification, let's talk about how to allocate your assets in a recession-resistant way. Asset allocation refers to the way you distribute your investments across different asset classes. The right allocation depends on several factors, including your risk tolerance, time horizon, and financial goals. Here's how to approach it. Risk tolerance. Assessing your risk tolerance is essential in determining how much of your portfolio should be allocated to stocks, bonds, and other assets. If you're someone who can handle volatility and want to potentially earn higher returns, you might allocate more to stocks, even during a recession. On the other hand, if you prefer stability and can't afford to take large losses, you may want to allocate a larger portion to bonds and cash. A good rule of thumb is the 60-40 rule. 60% of your portfolio in stocks and 40% in bonds. However, if you're closer to retirement or want to play it safer, you might adjust this to 50-50 or 40-60, stocks to bonds. Recession-proof portfolios generally have a larger proportion of defensive stocks, bonds, and cash. Age and time horizon. The younger you are, the more aggressive you can afford to be with your stock investments. If you're in your 20s or 30s, you have decades ahead of you to recover from any downturns. For people closer to retirement, however, it's critical to focus on capital preservation rather than growth. As you age, your portfolio should shift towards more conservative investments like bonds and cash equivalents to protect against volatility. Stay flexible. The market is always changing, so it's crucial to regularly review and adjust your portfolio. During periods of economic uncertainty, you may want to rebalance your portfolio by adding more defensive assets or adjusting your stock-to-bond ratio. Having flexibility in your asset allocation will help you adapt to changing market conditions and protect your investments. Chapter 4. Defensive investment strategies to consider. Building a recession-proof portfolio isn't just about choosing the right mix of assets. It's also about adopting specific defensive strategies. Let's take a look at some strategies that can help protect your portfolio during economic downturns. Focus on dividend-paying stocks. Dividend-paying stocks can provide regular income even when the market is down. Look for companies with a strong history of paying and increasing dividends. These companies are often more stable and well-established. Some good examples include companies in utilities, consumer staples, and healthcare sectors. Dividends can act as a cushion during market declines, helping to offset some of the price drops in your stock holdings. Invest in high-quality bonds. During recessions, government bonds, especially those issued by the U.S. Treasury, are often seen as safe havens. Investment-grade corporate bonds can also be a good choice, as they tend to hold up better than stocks. The goal is to own bonds that offer stable returns with low risk. Be mindful of bond durations, though. Long-term bonds can be more sensitive to interest rate changes. International exposure. Having international investments can also help shield your portfolio from domestic recessions. Different economies can go through downturns at different times, and while one region is struggling, another might be growing. International stocks or international bond funds can offer better diversification and reduce the risk of being tied to a single economy. Focus on essential sectors. Some sectors are less sensitive to economic downturns than others. These include industries like healthcare, utilities, and consumer staples. In fact, during recessions, people still need healthcare, food, and basic household products. Investing in companies that produce or provide these goods and services can be a solid defense against economic contraction. Chapter 5. Avoiding common pitfalls in recession-proofing your portfolio. While building a recession-proof portfolio is important, it's equally crucial to avoid some common mistakes that can undermine your efforts. Panic selling. The worst thing you can do during a recession is panic sell your investments. Markets will go up and down, but history shows that staying the course often leads to positive returns over time. Selling in a panic locks in your losses and prevents you from benefiting from the eventual market recovery. Overloading on bonds. While bonds are important in a recession-proof portfolio, overloading on bonds can limit your growth potential. Bonds are safer, but they offer lower returns compared to stocks, especially in a low-interest rate environment. A balanced approach is essential. Neglecting to rebalance. As markets move, your asset allocation may drift from your desired target. It's essential to rebalance your portfolio regularly to ensure it remains aligned with your risk tolerance and financial goals. This will help you avoid overexposure to one asset class. Building a recession-proof investment portfolio is about being proactive and strategic. Diversifying your assets, staying flexible with your allocations, and employing defensive strategies can help you navigate economic downturns with confidence. The goal is not just to protect your wealth but to position yourself for long-term growth, no matter what the market throws your way. Remember, recessions are inevitable, but with the right portfolio, you can weather the storm and come out even stronger on the other side. Keep your focus on long-term goals, stick to your plan, and don't let short-term volatility derail your investment strategy. Thank you for tuning in. If you found this guide helpful, be sure to like, share, and subscribe for more financial insights. Stay informed, stay strategic, and most importantly, stay invested.